So many people assume that a cut in the Bank of Canada's interest rate will automatically makes all mortgage rates drop. But here's a surprise. A Bank of Canada rate cut does not necessarily directly lower fixed mortgage rates. Your fixed rate is staying high isn't a mistake. It's a common misconception that we're about to clear up. I'm Lorne Andrews from Dominion Lending Center's Expert Financial and OptimalFinance.ca. So fixed rates follow bonds, not the Bank of Canada. Fixed rate mortgages have a mind of their own. They're actually tied to the bond market, specifically the Government of Canada 5-year bond yield, rather than the Bank of Canada's overnight policy rate. Banks use those 5-year bond yields as a benchmark when setting fixed mortgage rates. So when the Bank of Canada announces a rate cut, it doesn't necessarily mean your 5-year fixed rates will drop the same day. In fact, a central rate bank cut has no immediate effect on fixed term rates because the fixed rates move up and down based on the investor's long-term outlook. If bond yields don't budge, fixed mortgage rates won't budge either. Simple as that. Still with me? Think of it like gasoline prices versus oil prices. So the Bank of Canada's overnight rate is like crude oil, okay? The fixed mortgage rates are like the price you pay for gas at the pump. So when crude oil prices drop, gas prices don't necessarily immediately drop the next day. You might only see cheaper gas if the oil stays low for a long period of time. Similarly, when the Bank of Canada cuts its rates, fixed mortgage rates don't instantly fall overnight. They're locked into those bond market trends. Just like the gas prices depend on more than 1 days of oil prices being low. And hopefully this metaphor will show you why the Bank of Canada rate isn't necessarily the magic wand for lowering the fixed rates. Now, variable mortgage rates, that's a different story. Variable rates are linked to the lender's prime rate, which moves in tandem with the Bank of Canada rate. So when the Bank of Canada cuts rates, banks often drop their prime rate. The variable rate mortgage holders see their interest rates and sometimes even their payments go down. In short, the Bank of Canada cuts equal immediate relief for variable rate mortgage holders. But fixed rates work differently. If you already have a fixed rate loan, your rate is locked in for that term. It won't change until renewal. No matter what the Bank of Canada rate does, it's not going to change. And if you're shopping for a new fixed rate mortgage, remember the price is based off bond yields, which only change when market forces like inflation, expectations, investor demand, when all those things change. A Bank of Canada announcement might influence those forces indirectly over time, but there's no direct automatic drop to fixed rates from a Bank of Canada rate cut. That's why you might hear that variable rates fell after the Bank of Canada cut. Well, the new fixed rates, they barely even moved. So to recap, Bank of Canada rates don't necessarily lower fixed rates because fixed rates follow the 5-year bonds, not the Bank of Canada overnight rate. However, variable rates do drop because they track the Bank of Canada influence prime rate. So next time you hear about a Bank of Canada rate cut, you'll know why your fixed mortgage rates might not budge, and it's not because your bank is trying to rip you off. So if you're a homeowner or a first-time home buyer and want to understand how these rate changes could affect you and how much you qualify for, it's a great idea to chat with a mortgage professional. Feel free to book a friendly discovery call or personalized advice on your situation. We can talk you through all your options, whether you're sticking with your current rate or considering a variable rate or anything in between, so you can make the best decision on your home financing. We're here to help you navigate these twists and turns in simple terms.